Professor, we have a margin problem. How large? Several billion. How many banks? Oh dear. In March 2021, one family office was about to trigger billions of dollars of losses across some of the world's largest banks.
Overall, find the names Archegos.
This is Archegos? I was expecting a giant hedge fund. So you're investing your own family capital? Then how does a private family office build positions this large? Let us start with the boring version. You pay $100. You now own the share. If the share rises $20, you gain 20. If it falls 20, you lose 20. Exactly. Cash ownership. In a normal share purchase, the investor pays for the stock, owns it directly, and receives its gains or losses. Normally, $100 of stock requires $100 of cash, but Archegos does not put up the full $100. Archegos posts collateral. The swap provides the economic exposure. So less cash controls a much larger position. That is leverage, and so is the loss. So leverage magnifies both. The bank needs collateral because the position can lose money. The position is down. We need more collateral. That is a margin call. If Archegos posts more cash, the trade can stay open. And if I cannot pay, then the bank starts protecting itself. And protecting itself can mean selling the position, which can push the price even lower. One bank, one exposure. Easy enough. We manage the risk we see. But Archegos is trading with several banks. Each bank primarily saw its own relationship with Archegos, and the total risk is much bigger than any single screen. Archegos used several counterparties to build large synthetic exposures to a relatively small group of companies. Our position is within our limits, but the market risk is accumulating in the same place. If this one falls, everyone feels it. The shares rise. Archegos becomes richer on paper. Add exposure. The portfolio is performing strongly, and stronger performance can support still larger positions. Archegos rose, gains whipsul further expansion. How concentrated is the portfolio? That answer seems to have lost weight on the journey. How much exposure do you have with other banks? Internal reality, external reassurance. Your liquidity looks adequate. Only if one avoids looking. These positions are getting very large. The client is profitable. Ah, the eternal contest. Inside several banks, Archegos was generating growing counterparty risk concerns. As the exposure is profitable, warning lights can look surprisingly decorative. We should reduce the exposure.
In now, our machine meets gravity.
In late March 2021, from Archegos is shocking.
Buy more. The price is falling, and Archegos is increasing the bet. Our cushion is disappearing. What had amplified gains on the way up, and now, everyone would like their
One margin call is inconvenient. Several at once is a liquidity event. We need more time. We need cash. As prices fell, multiple prime brokers demanded additional collateral almost simultaneously. The fragmented to whole become one very fragmented. If we all sell at once, we destroy the price.
If nobody sells, our exposure keeps growing.
Cooperation and expiration date. Prime brokers discussed how to manage the unwind without triggering a disorderly fire sale.
And every bank has the same uncomfortable thought.
What if someone sells first?
Exactly.
Start selling. They are liquidating.
Reduce our exposure.
On 26 March, prime brokers began unwinding billions of dollars of Archegos-linked positions.
There are not enough buyers at these prices. Selling a small position is easy.
The market is moving against the collateral faster than we can sell it.
And now the liquidation feeds itself. Stop the selling. At this stage, the client no longer controls the exit.
Same client, different exit time, very different result. We are almost flat. We still have billions to unwind. Banks that reduced exposure nearly absorbed much heavy one equally. In total, Archegos caused more than $10 billion of losses across its banking counterpart.
$27 billion?
Gross exposure.
And the margin? That is a very large building standing on a
23rd March, Credit Suisse had roughly $27 billion of gross Archegos exposure, while average swap margins were around 9%. Archegos was not one mistake. It was several risks reinforcing each other. Synthetic leverage, concentrated positions, and fragmented counterparty information created a structure that became fragile when markets turned. And the other banks? If you cannot the whole cast a position, not harder question. So was the leverage really invisible? Not invisible, fragmented. The contracts were different, the risk was not. Archegos showed that economic risk can be distributed across contracts, banks, and legal structures without disappearing. Reality consolidated for everyone. And when the market turned, Archegos disappeared quickly, but the consequences remained on bank balance sheets, risk committees, and careers for years. Nothing about this contract looks particularly dangerous, until you add them together. So that is the lesson? The lesson is simpler. Risk does not